Hello, everyone, and welcome to another great webinar from CPA Academy. Thank you for joining us today. My name is Gabe, and I'll be your moderator for today's webinar, Real Estate Tax Strategies, Unlocking 179D Energy Efficiency Deductions. Our presenters today are Eric Tuthill and Roy Moorhead. Before we get started, I wanted to go through some housekeeping items and do some technical checks just to make sure that everything is working. First, if you don't mind going to the Q&A tab on your control panel, and please let me know if you can hear my voice and see the title slide. Feel free to let us know one thing you'd like to learn from today's webinar. If anyone has any technical issues, please let me know in that Q&A tab, and I'll do my best to get around to everybody as quickly as possible. This is also where you can put your questions and comments for the presenter. And I see them coming in fast and furious. They're coming in from Florida, from Oklahoma, California, Dallas. Thank you so much. So now that we know that everything is working, let's go through some housekeeping. This webinar qualifies for 1 CPE or 1 CE credit. CPE credit will be available within 24 hours in your CPA Academy account. And for attendees with a P10 on file, we will upload your CE to the IRS at a later date. You'll earn that credit by staying logged in for 50 minutes and answering the poll questions. There will be 4 polls today, and to earn credit, you'll need to answer at least 3 of them. I also wanted to let everyone know that we're recording today's webinar, and the archive, along with your credit, will be available in your CPA Academy account within 24 hours. And if you have to log out or log back in for any reason, our webinar software will keep track of your time. We also recommend you download today's presentation materials, which can be found in the control panel's handouts tab. So now that we're all set, let's welcome our presenters. Eric and Roy, the floor is all yours.
All right, thank you very, very much for the introduction there, Gabe. All right, so today we're going to talk about this CPE is going to be Real Estate Tax Strategies, Unlocking 179D Energy Efficiency Deductions. My name is Eric Tuthill. I'm a CPA, and I am a tax director with Corporate Tax Advisors. Before joining Corporate Tax Advisors, I was in the same position as a lot of you folks are. I was a CPA advisor. I worked for a lot of mid-tier firms and then eventually opened my own practice before building it up and selling it. So I understand a lot of how you guys will view these particular types of deductions and how you're going to have to translate them and put them into action for your taxpayers. I'm also joined with Mr. Roy Moorhead, and Mr. Roy Moorhead has been in this industry for the last 7 or so years and has worked on saving taxpayers millions and millions of dollars. And without further ado, I'll just go ahead and step on into the slides. The way that I should say, the way that we kind of organize this presentation is we wanted to do it in a way that we thought was most effective for you, the CPA or advisor, right? And so when we looked at how we should divide this, I always ask myself these same types of questions whenever I'm trying to learn something new and trying to apply it for my taxpayer and to save them the most amount of money that I possibly can. I really want to know in depth. The first thing that I want to know is essentially how much does this section 179D save taxpayers, or how much does this particular topic save taxpayers in general, right? Because that really gives us the marker for, is this worth it to pursue or not? And so we've got that divided up here in the presentation. And then the other thing that I want to know is I always really want to know how this works and how this functions from a logistical standpoint, first and foremost. And then secondly, what are the IRC codes, or what are the revenue proclamations and stuff like that back up such a deduction, right? Because I want to make sure that I'm doing something that's above board and that meets all the merits of a deduction. So I really want to know a little bit more of the ins and outs on what really justifies this deduction and how it really works in general. And then the third thing I want to know is, who does this apply to? Where do we raise our red flags? How do we identify what the taxpayer is that can actually take advantage of these particular types of deduction? And how do we integrate these deductions and plan to their overall advantage, right? So that's essentially how I kind of look at this. And I'm hoping a lot of you folks who are on this presentation today really look at these things for your taxpayers and your clients, and how you really want to apply a lot of these particular types of deductions. All right, so with that being said, it's time for our first polling question. So I'll hand it over to Gabe really quick.
Our first poll has launched. This is our first of 4 polls today, and it'll be open for the next minute or so. So please get those answers in for us. I'm available in the Q&A if anybody needs any assistance. Right back to you, Eric.
All right. Thank you very much, Gabe. And so this part of the topic that we're going to jump into is essentially how much does Section 179D save taxpayers? And as I said, the way that I always look at this is I really want to know at the end, what is the bottom line for the taxpayer? How do we translate these things into actual actions, and what does that actually look like on their tax return? What are the deductions that we're looking at in terms of integrating something like this or a process like this for a particular taxpayer? And essentially, how much can I save them in money? Because we always have to justify our value. I think a lot of folks here would agree that we have to show that our hourly fees are worth it, and our advising, it saves them a lot of money on their bottom line, and that it makes sense to continue working with us. So with that being said, I'm going to introduce you to a person that has saved his taxpayers and taxpayers that he's worked with millions and millions of dollars in taxes by utilizing this specific deduction. And that is Mr. Roy Moorhead, and he will go ahead and take it away from here. All right, Roy.
Thanks for that, Eric. Yeah, and again, to reintroduce myself, my name is Roy Moorhead. I'm a senior director here for corporate tax advisors, and my entire career has been focused around delivering 179D deductions to multiple types of clients. So really the first way I like to explain this deduction is it's defining exactly what it is. So the formal name of 179D is the Energy Efficient Commercial Buildings Deduction. And the overall intent behind the deduction is to incentivize building owners and the AEC industry to continue doing innovative and energy efficient upgrades and new construction for either commercial space, commercial real estate, or even like government and non-tax paying entities. So the overall bare bones of the incentive, it focuses really on 3 different systems. And that is the building's HVAC system, the interior lighting system, or the actual building envelope system, which is technically like the shell of the building, right? So there are multiple types of people that can qualify for this deduction, and it can actually be awarded from a government or nonprofit entity. And this can include things like K through 12 schools, things like higher education, really any non-tax-paying entity. You can go all the way down the list of different types of entities that actually can take advantage of 179D. But the main focus is on the HVAC, the lighting system, and the building envelope system, and how it relates to a predetermined ASHRAE standard that it takes to actually qualify. And the ASHRAE standard that we're looking at is 90.1 2007, and the scales that you have to actually look at in terms of energy efficiency savings is anywhere from 25% all the way up to 50%. And then with the Inflation Reduction Act now in play, there's a 5 times bonus rate if you meet certain criteria like prevailing wage and apprenticeship factors. You want to go ahead and hit the next slide for me, Eric? So now here's a breakdown of really how the incentive is awarded for clients that meet prevailing wage requirements and clients that don't, because it's based on a sliding scale. So again, baseline is always going to be hitting 25% or above on that ASHRAE standard. So, and it's always going to be adjusted for inflation, right? So every year the deduction amounts can vary. And the best way to think about it here is, as you can see here, there's typically, if you don't meet prevailing wage, and say you're hitting 25% of that ASHRAE 2007 standard, it's about a 2 cents variance, right, for inflation. So you can see here an easy example, first bullet on the screen, 25% at 57 cents per square foot of the building. With prevailing wage, you're going to be capped at 57 cents. With prevailing wage, as you can see, it drastically increases with that same exact percentage threshold all the way up to $2.83. So when you're talking about square footages in buildings, it does not take a lot of work for numbers to really start adding up relatively quickly, specifically if you're hitting those prevailing wage and apprenticeship requirements. And again, this goes all the way up to 50%, which can yield you a max of $5.81 and on the very low end, $1.13. So you can see there's a massive difference, not only between inflation, but with prevailing wage and without prevailing wage. And Eric is going to dive a little bit more into prevailing wage and the apprenticeship requirements. But there's a gives you a really good overall idea of how it's not take it or leave it. Just because you don't qualify for the maximum amount of deductions, you can still get a piece of the pie depending on your impact of the efficiency of a building. Can you hit the next slide for me, Eric? So this kind of goes back to really who qualifies for 179D. And bare bones, it is for building owners. Now, you can be a building owner, say, for commercial investment or for-profit buildings. And these are your like real estate investment companies, private equity firms. Think of like office buildings that companies actually invest in, they buy. And this is a tool that they can use to depreciate all of that. Now, when you go into the other side of 179D, this is where the AEC industry really comes into play. And it comes into play in a big way because it opens it up to different government entities. So the overall idea behind 179D is to incentivize the AEC industry to continue to do energy efficient upgrades and new construction. Now that 70% of the buildings in the United States are actually entities that don't pay tax, that is what opens it up to eligible designers. And then some examples of those are like the architects, the engineers, the controls contractors. There's a long list of other types of companies within that AEC space that can take advantage of this if their focus is really on doing government work. So think of it like if I'm an architect that does a lot of K through 12 schools, the first question that I might get asked is, well, why doesn't the building owner take this? Well, the entire reason this is here is because that building owner has no use for this deduction. So primary designers can actually utilize this on their behalf. Can you hit the next slide for me, Eric? Now, when we're talking about basic qualifications, really from a ASHRAE standard perspective, it really falls into two buckets. Are you doing improvements, additions? These are like your renovations of buildings. Or are you focusing on new construction? Or are you focusing on a mix of both? The good thing about 179D is it's open to both new construction and renovations. Now, a good rule of thumb to think of from a qualification standpoint is that typically improvements, additions, renovations, specifically in that HVAC and that lighting sector, they're going to hit anywhere from 25 to 35% of that ASHRAE standard. Now, if you go down here and you can see the new construction drastically increases. The same type of work will yield you most likely anywhere from 40 to 60% of that ASHRAE 2007 standard. So right now, since we're still operating under that low 2007 standard, there's never been a better time to take advantage of 179D because it's really attainable for both types of businesses. Can you hit the next slide for me, Eric? And right here, Eric and I put together just a quick example of what a new construction 179D deduction could actually benefit from. So right here, you'll see that we put it at 100,000 square feet. And since this is a new construction, we went ahead and put the efficiency standard of that ASHRAE code at 50%. So this is assuming that your work on one of those systems, either that HVAC, the interior lighting, or the building envelope, hits that 50% threshold. If you did not meet any prevailing wage requirements, you're going to be at $1.13 per square foot of the building, which is going to yield you $113,000 deductions. And just for the sake of easy numbers here, assuming this is a flow-through entity and when we're looking at a 30% tax rate, this is going to yield a cash value to your client of almost $33,900. Now, the same exact work in the same exact year, if that prevailing wage is met with the 50% threshold exceeded, you can see it jumps all the way up to $5.65 with now a total deduction of $565,000, which is now yielding your client almost $170,000 cash value. So you can see that numbers really add up relatively quickly. And for these types of businesses that are consistently doing a lot of government work, it puts them in a position to not only get extremely competitive, but also a tax plan for future liability coming down the pipeline. There's another example on the next slide that I'll show you that actually compares this to an addition versus a new construction. So the same square footage building, but since it was a renovation, most likely it's going to hit the 30% threshold. And you can see without prevailing wage, it's going to be hit at 68 cents per square foot, yielding $68,000 in deductions and a $20,000 cash value to your client. Now, the same exact work with prevailing wage yields you all the way up to $3.39, which is almost $102,000 cash value to your client. So again, this just shows how big of a difference prevailing wage and apprenticeship means on these buildings. But it also shows that if you don't meet these prevailing wage requirements, there is a big opportunity to really limit your liability simply by doing the same thing that you always do within your business. Can you hit the next slide for me, Eric? Now these, and then this kind of brings me to my next point, and what exactly do I mean by when I say government entities, right? A lot of people, when I say public sector or government entities, they kind of think of, hey, military bases kind of thing. But in actuality, it is any non-tax-paying entity. So right here, Eric and I broke down really the biggest types of different clients that we see and the actual average square foot associated with it. So it can be a hospital. It can be a multifamily high-rise. I believe I saw someone ask about that. And the caveat with multifamily projects and government entities is that it does have to be 4 stories or above. But as you can see, these U.S. averages square feet, numbers drastically increase in square footages. Now, schools are another huge opportunity for 179D because the square footage on a school is relatively large. And I'll walk you through an example for let's say the high school. So if my client is an engineer and they were in charge of the actual mechanical design of the HVAC system, and they can actually take a look at how much efficiency that their work specifically saved that building and relate it to the actual square footage of what the IRS allows, which is total area impacted. So in this example, a lot of engineers that work on mechanical design, they say, well, hey, look, I only worked on the chiller and it only takes up about 10,000 square feet. But your work actually impacted the entirety of that 200,000 square foot high school. And since this was actually a lower efficiency at 35%, with prevailing wage, you can still yield almost $159,000 deduction, and with the actual prevailing wage, now you're upwards of $791,000 in deductions. So you can see how the cash value really is impacted by really the type of work that your clients are already doing on a consistent basis. Can you next slide for me, Eric? And this is the same exact sort of spreadsheet, but it compares it now to higher efficiency outcomes. So things like, newer construction, when you're actually getting into higher percentages, hitting the 50%, hitting the 60%. That same example with a high school now all of a sudden can yield almost $340,000 cash value to your company if prevailing wage is met. If not, you're still yielding $226,000 to your client because this is a higher efficiency building since it's a new construction. So it's a lot easier to hit those ASHRAE standards. So the point of these slides in this section were to highlight the big difference between a renovation and a new construction. Can you give me the next slide, Eric?
And Roy, I'm going to jump in real quick and get our second poll launched for our attendees. This is our second of 4 today, and if anybody needs any assistance, I'm available in the Q&A. Right back to you guys.
All right, folks. So there's a couple things that I just wanted to kind of go over here as well. And like I said, I think one of the things about how I look at things is probably a little bit different from how Roy would look at things. And it's kind of, from a CPA's perspective, what are my red flags? What are the things that I kind of need to know high level about this deduction before we move on to any kind of next stages? And I think the big thing to kind of understand is that it's basically any improvement that's done to the HVAC system, the lighting system, or building envelope, and that also includes new construction. And when it's new construction, it has to be developed by the real estate investor, essentially, right? So if we got a large real estate investor that's doing an apartment complex or something like that, they basically kind of qualify for this off the bat, because what we're doing is we're looking at a 2007 standard. Things have markedly changed since 2007, especially in terms of energy efficiency, right? So if we're comparing ourselves to a 2007 standard, the majority of new property that's being built right now is going to qualify in some way, shape, or form, as long as it's kind of being commissioned through that entire process, right? So the thing about this that we kind of really have to understand is it's essentially looking at an old model from 2007 and just showing, are we better than 25% of that, the energy efficiency in 2007, 18 years ago? And all you have to do is just kind of prove that, in any of these improvements that happen. That's basically how this works, right? And of course, there's some other things to kind of keep in mind, and we'll go through how this works as well, and this that we can identify that are kind of get us around this prevailing wage and apprenticeship. And you can see that there's a huge difference in the deduction here with the prevailing wage and apprenticeship kind of components that we always have to be worried about. Like, are we going to hit this prevailing wage and apprenticeship stuff? There's some things that we can do on the front end as advisors in order to ensure that our taxpayers are actually meeting these parameters. I think that's one of the most important aspects of this webinar that we're going to talk about today, is kind of getting in front of taxpayers and really trying to tell them essentially how this stuff can work for them. So moving into that section, we just want to talk about how these Section 179D deductions work, I think, in total, right? So we can kind of see what the history is, what the regulations have been over time, and how these things have kind of morphed, right? So this actually was, oh man, that's a huge screen with a lot of stuff. I don't know when I did this, but there's a lot in there, right? So there's been a lot of law that kind of circles around the Section 179D. It's almost like they got some architects and engineers and a lawyer in the same place, and they tried to design a perfect tax deduction for them, right? Not necessarily for accountants who have to interpret all this stuff, but it does exist, right? And of course, we have to kind of understand at least high level what we're looking at before we start getting engineers involved. So first of all, it was established in 2005, right? And they basically said, okay, if we meet these certain energy efficiency parameters, we can take the energy efficiency that they met, right, over that 20, and back then it was a little bit different, right? It used to be you could look at every single section. You could basically give a partial look at what was done in the air conditioning, what was done in the lighting, and what was done in the envelope, and you could look at those separately. But now we have to kind of model all three of these factors. But you can see kind of how things evolved over time. They basically, there was a component there where they started establishing modeling standards. There was a component here as well, or another revenue proclamation that discussed more designer eligibility and how these things can be passed off onto the actual creators or designers of a particular property. And as Roy mentioned before, there's two types of taxpayers that we're really looking at here. One is the person that actually owns the property or installed the property, and that's usually the for-profit kind of folks that we're looking at. And then there's the government entities that installed these properties. It's more the designers for these government entities, essentially, that can get allocated this specific deduction. And that's where we really see a huge boon to a lot of folks, is usually in this allocation component. And we'll talk in excruciating detail here about what that really looks like for people. But essentially, you just have to get an allocation letter from these government entities. They have to meet these modeling standards. There's a couple softwares that have been approved by the IRS in terms of modeling specific aspects of the energy efficiency. At least that's how I've interpreted it as an accountant, right? And then, of course, the big one is the IRA that just recently came out, and that's the one that a lot of people are probably joining on here or join this specific CPE in order to kind of get a better understanding of how the Inflation Reduction Act kind of changed things. It included REITs, but the big thing was the prevailing wage and apprenticeship requirements, which it kind of throws a little bit of a wrench in it in the for-profit owner sphere. You usually have to have a large facility that you're working on in order to kind of really take advantage of that credit, unless you kind of work on the contract end up front and really make some adjustments to things. So that was one of the bigger aspects of the stuff. And then there was this Revenue Proc 2023-11 that came out, and that one is probably the most impactful to a lot of the folks here today, and it really helps from a planning perspective. Because in that revenue proclamation, they basically grandfathered a certain amount, a certain time period, and they said, if you guys began construction before this certain time period right here, you're going to automatically qualify for the 5X rate. And so it's hugely impactful for folks, especially if we're looking historically, that they could qualify for this without having to go through all of the rigmarole of getting together the prevailing wage and the payroll and stuff like that, and proving it in front of the IRS that we met these parameters and are qualified for the 5X rate. And you can see, I think, in that same little document right there, essentially January 29th, 2023 is the most crucial date. If we have a property owner that started construction, say in 2021 or 2022, and then they ended up completing the construction in 24, 25, they don't have to supply any of these prevailing wage and apprenticeship requirements. They don't have to actually meet these parameters, and they still get the 5 times bonus rate, right? So that's what we have to kind of look for from a planning perspective, is we have to look for people that have projects within that particular time period that we can maximize that benefit for, and that they began construction during a particular time period. And you'll see that for a lot of 2024 taxpayers, especially if you're looking at your current clientele list. This is the time to get in there and really take advantage of this particular tax deduction, right? Because we have this little window of opportunity here to claim this 5X without having to do a lot of forework in trying to get the prevailing wage and apprenticeship items passed. And there was a lot of other court cases, and a lot of the court cases really involve, I shouldn't say there was a lot of court cases. There's only been about 3 of these, and you could see statistically the IRS would have a little bit more of a difficult time actually auditing these types of projects. So that's why we haven't seen a lot of court case law, if you will, but there is about 3 court cases in there. Generally, one of the court cases, it was essentially that we needed to limit our deduction that is taken to the cost basis of the property, right, that was installed. And so that's the case all across the board, whether you're the original installer or you're the owner or you're the designer, right? It's got to be limited essentially to the cost basis of the property installed. So you can't take above and beyond that factor, right? Even if we have that square footage that goes to a certain extent, right? And then there was one that was basically on design, and who is a designer, who isn't a designer. We'll talk a little bit more about that in some following slides, but that's the gist of it. Like if you look at a lot of these things, they really want the government really wants to kind of push this incentive, right? Because it really helps develop energy efficient properties overall across the board, and continuing onward, it helps with energy efficient properties. And this one is surprisingly, this is a deduction that is favorable for both Republicans and Democrats. In the last update that just came, the big beautiful bill that people have probably, maybe you guys have glanced through some of the things that they've kind of put into this, like the no tax on overtime, no tax on tips, and the increased child credit, and a couple of other items in there. They went through and they limited some of the provisions of the IRA. So they didn't eliminate, where they reduced quite a bit. I think they're going to try to eliminate the electric cars kind of components and a couple other things there. And they tried to limit the 48E, which is the ITC or investment tax credit. They tried to limit that quite a bit. But one of the things that they did not touch was this Section 179D. At least that's not in the House bill that we see so far. So just important to kind of know that as we're planning for clients, especially 2025 onwards, what that really looks like. So part of how Section 179D works, I think we talked about how there's 2 types of taxpayers. And so I'm going to talk about how there's kind of different treatments for each one of these types of taxpayers. The taxpayer type 1, which I've classified here, is essentially for-profit owners of commercial property. That's people that actually went through the development process here and installed the property one way or another. Either they bought the property originally and then did an installation of an HVAC, or they did an installation of different lighting kinds, or they did some building envelope upgrades, or they did a combination of all the three things. Or they did the new construction, right? Those are the people that we're really looking for here. So if they did any kind of improvement or new construction there, and they got between that 25 to 50% efficiency gain in energy, the tax deduction, like I mentioned on the last slide, it's limited to the cost basis of the eligible property installed, right? So if you installed an HVAC and you only paid $100,000 for the HVAC that you installed, you're kind of limited to that $100,000, no matter what the square footage is, no matter how you're applying the amount of the deduction, and no matter if you met prevailing wage or apprenticeship, it doesn't really matter. It's going to be limited to the cost basis of the property first and foremost. And then the thing that we need to know from a property owner perspective is that this is considered a 1245 reduction, right? So it's just like depreciation. And when I say it's just like depreciation, we're going to reduce the basis of the property that's installed on our depreciation schedule by the amount of the credit, right? Or I shouldn't say credit, the deduction. We're going to reduce the amount of the basis by the deduction, right? And so when we actually do end up going and selling the property, we do have to reclaim that deduction, and it becomes, an ordinary tax, just like it would for the depreciation that we would take on the property, right? So it's going to be the exact same. And so, really you got to look at, it says I'm going to take my camera off just in case I am a little bit laggy here. I apologize if there's a quick intermittency. My internet has been going on and off today. So, one of the cool parts about this is being able to time this deduction with particular tax issues that may occur, especially if we're looking historically at a client that may be in trouble. I say in trouble from a tax perspective. That means that they owe a lot more in tax than they have in the past. And so if we're looking at somebody like that, and if we're looking at like a large real estate investor, and back in 2021, they did a brand new construction on a specific property. Well, you can, or I should say, maybe they did 2022, brand new. They finished brand new construction on a property. Well, that should meet the parameter there of getting you the 5 times bonus rate. But you can also move that into the current year tax period if you own the property by using an automatic change in method, right? So you can push that into that particular tax period. It doesn't matter how long ago that property was really installed, just as long as it meets these energy efficiency parameters if you own the property, because you can use an automatic change in method just like you can with a cost segregation study. And you can accelerate that deduction into the current year time period and take that against your current year tax liability, right? With this 481A adjustment. That's the cool part about automatic change provisions, right? And so one thing to note here is you can only take this once every 3 years on property, basically from this IRA provision. So you can only really take a 179D deduction once every 3 years, right? That's one thing to kind of keep in mind. And this is when we talk about what the client talking or the planning point is regarding prevailing wage and apprenticeship requirements. And I think that this is really crucial for planning and getting in front of taxpayers that could possibly qualify for this. I mean, there's a lot of folks right now that are probably looking at their 179D deductions and wondering what happened and why it got so small. And that was because they couldn't provide the proof that they met the prevailing wage and apprenticeship requirements because they didn't meet that grandfathered exception there of January 29th, 2023, right? So as long as we can, if they haven't met that, and they couldn't possibly meet it based off of historic construction that they've been doing, but they've got construction that's coming up, they can start working this into their contracts that they are working with their contractors on. Because the issue that really comes to mind here when you have a for-profit taxpayer is that if you have to provide prevailing wage and apprenticeship, that means you have to go to your contractors, the people that built your property, and ask them for payroll. And a lot of these guys are going to be very unlikely to give the payroll of the where they have profit margin baked in they're going to really not want to procure that payroll and prove that they met this prevailing wage apprenticeship, especially if we're looking at this from a historic perspective. So you have to get out in front of this and plan for this from a taxpayer's perspective. So the best thing to do, in my opinion, is to integrate this into contracts that you work with on specifically with contractors that are going to be working in these arenas, right? So your HVAC guys, your lighting guys, your building envelope guys, like your installation contractors, et cetera. If you are the for-profit business owner, if you really want to take advantage of this, the best thing to do is just have some standard stuff into your contract or baked into your contract here that allow you to procure the payroll that you need to be able to justify the prevailing wage and apprenticeship component. Right. So if you get it out in front of them, it's going to be much more likely that you're going to be able to take advantage of this and actually be able to use this, because you are very likely to meet prevailing wage, and we'll talk about why you'd be likely to, like, why most of these people will actually be likely to meet prevailing wage. They might not necessarily meet apprenticeship requirements, but you can also bake that into that contract component. So you can say, hey, you guys need to have a certain amount of apprenticeship people on site. So you can work that in, and that will really maximize this credit for you. The other thing too is, like I said, you want to keep on the lookout for properties that were placed in service in 2024, right, or 2023. If you look at properties that are placed in service in 2024 or 2023, there's a very high likelihood that they commenced construction prior to this grandfather date running out, this January 29th, 2023 date running out. So there's very high likelihood that they're in there, and you could probably maximize your deduction to the biggest extent possible, right? So taxpayer type 2, and this is the taxpayer 2 that are also having some of the same issues around prevailing wage and apprenticeship programs. And that's usually like the architects and engineers, not necessarily the construction contractors who actually perform the work, because they actually have the payroll and all that stuff that you need to prove that you meet the prevailing wage and apprenticeship components. But the architects and engineers who actually do the majority of the design and have reaped the benefit of this particular tax deduction over the last few years are probably starting to experience a little bit of an issue with being able to take the full deduction. So they're kind of erring on taking the lesser deduction or the non 5 times bonus rate. And that's usually an issue with how they're formatting their contracts. And you can slip into any contract that you have with the government. You can slip in a parameter there about Section 179D that they must procure, some of the data that you need to meet this 179D allocation components there, and that you are the person to be given the Section 179D allocation. You can put that into your contract. Of course, that becomes a negotiating parameter with the government entity, but you will still be able to take, full advantage and get 5 times the bonus deduction on it. So that's a big aspect here, a big difference between those two is that the architects will probably want to do that a little bit more. So the very specific kind of way that this works for designers of government and nonprofit energy property is that this tax deduction, it's really just allocated through a simple allocation letter from the government or nonprofit entity. It's not a super huge document that's full of a lot of crazy things in there. There's just an attestation that you're a designer of the property, and this was the amount that was spent on the property, and this is the address of the property, et cetera, right? So from a government or nonprofit entity, they don't take any liability for signing the allocation letter or anything like that. You can just essentially send this to them, have them allocate it over to the contractor or architect or engineer that you may be working with. It's a relatively simple process. And then the tax deduction, I think, like I said before, it's limited to the cost basis of the eligible property installed. So it's basically whatever you charged, or whatever if you were the architect or engineer, whatever that property actually ended up costing, that would essentially be the limitation on the deduction there, and you're limited to the amount that you're charged, right? And this is the cool part, the really, really cool part for designers in government, nonprofit, energy efficient. The designers of government or nonprofit energy efficient property, right, is that deduction, it's not subject to recapture, unlike it is for the for-profit guys. So this is a very clean deduction. It's just a straight deduction that they don't have to worry about a lot of the different aspects that you would normally be kind of worried about, like I said, reducing basis and some other things that you could possibly do. That this is just a pure clean deduction. And as a matter of fact, we talked to a taxpayer the other day that had saved millions and millions of dollars by going back and looking at his past projects and just taking those deductions, right? So it's pretty good dig for the designers of specifically. Obviously there's some aspects of issues with it with the for-profit guys. One of the bigger differences here is that you can't do a 3115, so you can't do an automatic method change. You can only amend returns to report Section 179D allocations. And you can only take this tax deduction once every 4 years on a specific government building, right? Or so they can only basically allocate a 179D deduction once every 4 years. We actually bake that into our allocation letters so that they know that that's basically a request. Essentially, you guys haven't done this you guys haven't done this for another taxpayer, right? And so that's really one of the big issues, I think. And when we're talking about these folks who are the architects, engineers, or contractors, really you want to look at their historic projects. You want to ask them some questions about what their historic projects look like, and what they've done over the last few years, especially like 22, 23, and that can kind of give you a better ballpark or idea of what their deduction may look like, right? So one of the big issues surrounding Section 179D is what is a designer? And per the IRS Rev Proc there 2008-40, a designer is a person that creates the technical specifications for installation of energy efficient commercial building property. And it is not a person that merely installs, repairs, or maintains that property, right? So design bid and doing alterations and putting in change orders and stuff like that, if you have a client that does that kind of stuff, they're more likely to be that type of person. They're going to actually be the designer of that property. Now, there are some aspects that we just really want to focus on from it. We want to say, okay, a person that's going in and just doing what they're told, and just installing and just maintaining equipment, those people are not considered designers for this. But if they're in there and they're suggesting what type of equipment it is that should be installed, that is a designer, right? And so it's really important to kind of understand what that looks like. All right, so this, and Roy's going to help me out here for a second too. This is some of the common technological improvements here from a CPA's perspective. Really, what I want to know is, I mean, did you guys work on the lighting systems? Did you work on the HVAC systems? Did you work on the hot water systems or the building envelope? I'm really going to just be looking at that from a red flag perspective in which to forward my client over to an engineer to have a little bit more in-depth discussion with them. But you can see there's plenty of different technologies that are available out there. So any comments on on any of the technological improvements, Roy?
Yeah, absolutely. So kind of like what Eric touched on, when you're working on government entities or nonprofit entities, it's really good to hone in on who is classified as a designer. And like Eric stated, someone who creates what is known as the technical specifications of any sort of project. And again, once you're dealing with the AEC industry as a whole, that can include a lot of different types of companies. So, traditionally you hear AEC, you're thinking architect, engineer, construction company. But realistically, there's a list of different contractors that are also under that umbrella that, depending on what we look for, are delivery methods to actually qualify a particular building. Now, when I say delivery methods, these different types of clients have different sorts of delivery methods that they submit or that they actually perform their work as. So an example would be a design build contract, where you're involved with the design phase from start to finish. Another example of qualified activity would be a delivery method called design assist, where you're assisting in the design, you're making recommendations, you're doing the appropriate change orders and submittals and proposals to the actual prime that's on the contract. And then there's a long list of other types of qualifications where 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 you can do like the change orders, the value engineering, whether you're making a different recommendation from what was on your actual design sheet, because you don't have to actually be the prime on a project to actually qualify for 179D. And when I say prime, I mean the one that actually holds the contract with the government entity. We just need to prove your qualified activity through proving your involvement within the design phase. So an example would be like a lighting system, though that's typically your electrical contractors. These are the people that are doing your LED fixtures, your occupancy sensors, anything really to do intertwined with the actual control system that are actually impacting the interior lights of that building. Whether that's just a simple switching from an older model to new LED lights, to actually installing different daylight occupancy sensors, dimming systems. These are all things that we look for when we're looking at an electrical contractor. Now, when you move down to like an HVAC system, these are typically your mechanical contractors, your MEP firms, which is mechanical and electrical all in one. What they're really doing, they can be retrofitting or even a new construction where they're replacing with a what's an RTU, which is a high efficiency rooftop unit, a VRF system, a variable refrigerant flow, any sort of upgrade to the boilers, the chillers, anything that's going to impact that energy efficiency from an HVAC standpoint, including the controls that actually impact the system itself, can all be looped in when we look at qualified activity. Now, same with the hot water systems when you're looking at the heat pumps, the geothermal heat pumps, anything that's really affecting that HVAC and those water systems are really going to drive an efficiency standard from a qualified activity standpoint. And when we get down to the bottom, which is that building envelope, this is really where we look, like I mentioned, the shell of the building. What type of roof is it? What are the windows? Are they double paned with glass in the middle of the window? What is the heat that's being radiated off of these windows? What type of R values do your doors and your overhead dock doors have? All of this can be factored into the building envelope when we're looking at extracting qualified activity from different types of companies that actually qualify. You can go ahead, Eric. I'm sorry.
Yeah, no problem here. Okay, so section 179D, just to kind of give you guys a little bit high level, I see a lot of questions in here. I'm trying to answer them, but we might not be able to. It looks like we're going to have to cruise through the rest of these slides a little quickly. But essentially, an energy modeler will take the ASHRAE standards, and they have like a separate kind of component there that they model themselves, and then you have a proposed building that is modeled as well. So this is what happens on the engineering side. And that basically kind of helps you determine what that efficiency improvement is in the three aspects using their engineering knowledge. And like I said, the IRS approved software for a particular modeling comparison standards, right? And like I've said before, and unfortunately we didn't have an engineer here join us today, but it basically requires a licensed engineering professional who reviews the modeling analysis and reviews the actual site and goes out and does the actual site there, that stamps on it. I'm a professional engineer. I looked at these. My energy efficiency is showing this, right, in terms of a difference between this one and the ASHRAE standard. So what you end up getting as a taxpayer's representative, or as the taxpayer itself, you end up getting a rubber stamped kind of report there that shows that the licensed engineering professional looked at and modeled these specific aspects, right? So that's really how that works. Now, in terms of the prevailing wage, we like. If you see over here to the side, I basically have an example of what you can look up if you go to the Davis-Bacon Act and you try to look up and see exactly what a prevailing wage might be. This is in the middle of nowhere in Texas, and you can see what they do is they take these surveys and they ask everybody around that area, hey, how much do you guys pay these guys, these specific types of professions? And they answer and they respond. And they say, well, I mean, $7.20, like minimum wage, right? So in the middle of nowhere, it's minimum wage because they got one guy doing a lot of different things. And so you can see here, I mean, it's not as hard as you would think in order to meet the prevailing wage parameters. So if you're working with a contractor and they supply these things, it's not as unlikely now or has been in the past to meet these different parameters. And we also have to think too, the Davis-Bacon Act, like a lot of these government contract buildings and stuff like that, they're gonna, a lot of these contractors that are working with, I should say contractors, or, the accountants and engineers, like anybody that's doing these types of projects, they have to submit certified payroll, especially if it's a federal entity. They have to submit certified payroll already proving the fact that they met prevailing wage, right? So from a design allocation point, you're almost kind of guaranteed to do that if you're working on a lot of government buildings. And a lot of these little states, you can see down here, like I've got this huge list of different states here that have mini Davis-Bacon Act compliance, right? A lot of these states have prevailing wage requirements as well. And if you have this mini Davis-Bacon Act component to it, you're submitting certified payroll. So you really just have to ask your taxpayer that you're working with, hey, are you guys doing certified payroll? Because if they're doing certified payroll, they're like almost 90% likely to hit the prevailing wage parameters. And so you would be surprised at how many people out there that are paying prevailing wage that just are not going through the process of getting this particular deduction because they just can't procure the payroll, right? So getting that integrated in the contracts is absolutely crucial for anybody that's actually searching to try to get and take advantage of these deductions. That being said, there is also an apprenticeship requirement, and that's essentially 15% for 2024 questions. 2024 people here. I know we're getting close to the line here, so you just have to meet these parameters. If you don't have enough apprenticeship on site, you can kind of make it up with the government and pay them like a slight penalty for the amount of apprenticeship hours missed, and a lot of times that won't necessarily be as difficult to get back with the government as it would be beneficial to the taxpayer to take that overall deduction, right? So just paying a little bit of kind of penalty there if there was an apprenticeship issue and they didn't get that in. But like I said, the best thing to do is to integrate that into a contract. So get with a lawyer, have your taxpayers get with a lawyer, get that integrated into the contract so that they're going to meet the apprenticeship parameters that you're looking for. And that also they're going to provide that payroll. So if you can get that aspect worked in with them, you're going to benefit a lot more from these types of deductions. All right, so last thing that we're going to go to is how do we identify the appropriate taxpayers and plan to their advantage? Well, there's a lot of different applicable taxpayers that are out there. And when we think about who we need to look through from our Rolodex perspective, we're really going to be looking at property managers. We're going to be looking at commercial real estate investors and investor groups, large investors, people that build a lot of these big properties, big partnerships that could benefit from a Section 179D deduction that do these multifamily things. And of course, architects and engineers with government and nonprofit contract work, right? And then the contractors, and there are so many contractors out there that they could possibly work with that you guys can look at. I mean, if you guys have an HVAC, almost everybody has some HVAC, the likelihood that they've done some government work at some point is pretty high, right? So those are the kind of guys that you want to red flag and move on to next steps with folks, right? And so, like I said, now we've identified, hey, these are the kind of clients that could actually utilize this particular strategy. And what do we do next? Well, it's best, you can see by just the spectrum of stuff that goes on here, that it's best to meet with an appropriate professional to help identify the projects that qualify, right? Because we're not engineers, we're accountants. Right at the end of the day, this gets a little bit too much into the engineering perspective for us to really give them a super valid answer on a lot of things, right? So the best thing to do is schedule and work with a specific engineer and kind of go through these from a project perspective. And we should also look at the projects from a historical perspective, because there are so many deductions that are out there. We're talking, I mean, we've found millions and millions of dollars in deductions out there for folks that just have not asked for an allocation letter from a government building, right? So if they've been working on this, why not take advantage of these deductions? Why not get as much deductions as you possibly can? And then you also want to look for project heavy investors with particular project work placed in service in 22, 23, 24. So I'm talking about those large taxpayers. Those are the kind of guys that we really want to look for, right? And I'm just going to go ahead and pass through this slide so we can get moving to one of the final slides here. I think we have the final.
Yeah, Eric, I'm going to go ahead and launch our final poll here. Our third poll was just launched and closed, and here's our fourth. Right back to you.
All right. And so what does the study process look like? And basically what you do is you kind of you schedule a quick call if you've got if you've identified a taxpayer that you think that this might be worth it to look at for them. We you can just schedule a quick call with our team, right? And there's actually a little banner that just popped down below, and that'll take you to a website there where you guys can schedule 30 minutes to just to chat with us. If you think that you have in your Rolodex a few folks that might apply for this, if you just want to get a little bit more of an understanding for those specific folks. But basically, you want to schedule a call with our team. And you can do that with the taxpayer, without the taxpayer. If you just want to just ask us a couple questions on whether they qualify, you can do that. And once we really find out they qualify, and we've talked through some of the issues that they might have and how they do qualify, essentially that's where we start going into a high level project analysis, and we start looking to see exactly what those values look like, and then we go and try to get allocation letters for folks. And from the allocation letter standpoint, then we start moving into the actual project modeling and analysis and preparing the reports and getting the deductions ready. And then when we actually deliver the deduction, you basically get this nice report here that kind of tells you exactly how you qualify, what forms to file, and how they're going to, what records to hold and keep, and how they're going to actually take advantage of these deductions fully in their tax return. And you just get a nice little rubber stamp there from a modeler or PE. And as always, we stand by our work, right? If there's any kind of issues, the IRS selects the return for exam, corporate tax advisors will be there to stand by the taxpayer through all of it, and try to make sure that their work is defended, that our work is defended well in front of the IRS, right? So that's pretty much it. I'm sorry to move through those last slides so quickly, guys, but I'm going to try to hop in here and see if we can answer one or two questions before we have to go. Let me see here. All right. There was a question, what's the difference between taking section 179 and section 179D on HVAC replacement equipment? Well, if you can take section 179, you're going to have you could probably take that up to whatever the business income limitation is, right? And that depends on whether you've got bonus depreciation, et cetera. But I mean, the big difference here is that we're talking about two separate sections of the code. We've got IRC 179 and IRC 179D, capital D, and the HVAC replacement equipment. Basically, if we can meet these parameters, you get to take that as a special deduction, right? And that deduction is a little bit more than, say, you could possibly take. You have business income limitations with section 179. Is there a recapture factor? Yes, there is a recapture factor with this type of deduction upon sale of the asset, but only for the for-profit owners or the guys that actually retain the property, right? The designers that get allocated these things, there's nothing. They don't have to worry about that. So they just get to take this nice fat deduction. And that's why those are the kind of people that you want to look through on your Rolodex of who can actually take these deductions. You really want to look for those contractors. You want to look for the designers of this equipment, right? That's going to be the biggest people that can help you. Does the contractor have to pay prevailing wages to be eligible? No, they don't, right? You just are eligible for a lower level of deduction, right? But if you're doing government work, majority of these guys are paying prevailing wage. Like I was saying before, there's a bunch of these little mini I think they're called little Davis-Bacon acts, right? In each one of these little states. So even if it's a state funded project, they're probably submitting certified payroll and they're probably meeting that parameter almost exactly, right? So that's very, very likely. Does 179D deduction reduce basis of the asset installed? Yes, it does. Absolutely. It does technically for the government, but they don't really, they don't pay any taxes. They don't really monitor their assets in the same way. So it's not really utilized. It doesn't work quite the same way for the designers who've been allocated this deduction. I think that was another question there as well. Does 179D work for self-rental properties? Absolutely does, right? So especially if you did any installation there of any HVAC equipment or anything like that. So with that being said, I need to give this over to Gabe so he can finish this off.
All right. Thank you so much, Eric and Roy. We really appreciate having you with us today. To wrap things up for our attendees, the handouts, archive of the webinar, and CPE credit will be available in your CPA Academy accounts within 24 hours. CE credit for attendees with a P10 on file will be uploaded to the IRS at a later date. And if you look in your email inbox, you will find an evaluation link for this session. So please let us know how we did. All questions that were asked today will be forwarded in a full report to our presenters as well. Thanks again to Eric and Roy for your excellent content and to our members for your participation. Please check the schedule on our website for additional information, and we hope to see you on a future webinar. Have a great day, everyone.
Thank you, everyone.
Thanks, everyone.